Alright, welcome back guys. So this is video, I don't know, 4? Losing track already. In the previous video, we talked about what a weekly options trade is. So that'll kind of keep you in line of where we're at, right? In this video, we're going to talk about why. Why trade the weeklies when we could get more premium if we went farther out? And we do use those strategies, right? I mean, we've got strategies that are running 21-day options. So why are we focusing on such a short duration strategy? Well, first of all, there are earnings, right? I know we're talking about indexes, but earnings do affect us, okay? Maybe you've heard me say it before, maybe not, but sometimes Apple moves the marketplace. Sometimes the marketplace moves Apple. It doesn't always have to be Apple. There was a time when Walgreens had some bad news and it dragged the Dow down over 500 points in a single day just by one company. Right? So while the indexes are not all the same, the Dow is different, a different kind of index versus the Nasdaq and the S&P. One's cap weighted, one's price weighted. They are affected by the markets. So uh, the stock market is not just a basket of stocks, right? Each stock on their own does matter, but collectively they do matter too. So we might want to trade a weekly trade because of earnings, because of an elevated volatility or news. We want to trade weekly options because we're closer to the target, right? You know, when you're far away and you're throwing darts, it's kind of hard to hit the bullseye, but when you get really close, it's kind of easy to hit the bullseye. Uh, we got a very quick decay, implied volatility, expected move, and theta and the Greeks. All of these different things are heightened, right? So when you're in a in an option that is about ready to expire, the pricing can get very volatile even if price off the underlying doesn't move very much. We would also want to trade weekly options if we are running in a small account because they're small account friendly. A small account needs that capital rotation. I can't stress this enough. I hear from people all the time who say, I'm trying to grow a small account very quick and I can't take big trades. So how am I going to do it? That is the balance and the focal point, the pivotal point in that is you have to be able to continue to move that money. So when you get into a trade, you need to be able to shut it down and open up a new one as quickly as possible. And the closer you get to 50% profit, the more that trade starts to slow down. When you're working on an options strategy and you're trying to determine how effective it is, how high your win rate is, you need to start really slow. All right? So the idea is close them suckers down at 10%, 15%. And look, I don't I don't make any promises that you're going to get rich doing this, but I can tell you you can grow your account very quickly. You can have a very high win rate trade, and you can grow that account, guys, with these little trades. You can, and you must. If you put on a very large trade, if you're taking half your account and tying it up and then sitting there unable to trade anything else for a week or 2 weeks just to get, say, $200, you could have already opened 15 different trades and hit $15 a piece in all those, and it just kept on running, right? So don't let your money get tied up and bogged down. Keep it moving. And that's why these trades can be so effective. When we were looking at the trades here where they popped out to the downside, this was Tuesday into Wednesday, and on Wednesday afternoon, perhaps into Thursday, you could have looked to take that back up. From Thursday to Friday, just like that, 2 days, you're out, right? The same thing uh, over here. when we broke to the downside. You could have looked to just hold that to the downside just because of how extreme it got. Through Thursday, you could have been looking at this and saying, you know, I don't think it's going to come back, and put on an iron condor or a credit spread right there saying, I don't think it's coming back. And 2 days, you hit your target and you're done. So if you're building these trades the right way, guys, you can really turn that money around very quickly. And look, I know if you do the numbers, they don't sound very exciting. Okay, it is not sexy. Say, for an example, we've got a $1 wide spread. And in that $1 wide spread, we're building it with a 1-to-1 risk to reward ratio. Now, what's that mean? That means I'm going to risk 50 cents to make 50 cents. If you're new to options, that means $50, not 50 pennies. Okay? So if I'm going to build a trade that's risking 50 to make 50, and then I'm going to shut it down early, that means I'm going to get less than $25 for this trade. So I'm really not risking 50 to make 50. I'm really risking 50 to make 25. But am I really risking 50? Do I really need to sit there and take the max loss if things start to turn against me? No. No, I can look to try to manage the losses just as much as I manage the winners, right? And if we're talking about closing them down at 15% or 10%, then we're really not getting that $50, right? So I get it, guys. I do. You know, it doesn't even feel like it's worth the effort or that it's worth the risk. But I promise you it is. It's not about the home runs. It's about the very high win rate, the very low chance of loss, right? When you're winning 95% of the time and you're not risking 4-to-1 like we normally have to do in a credit spread, right? You know those places, you go see them on the internet. They're talking about looking at a range-bound market like this, and they're saying, oh, this is perfect. You know, let's go $5 or $10 out of the money and put on a credit spread down here, and maybe you collect $25 and you're risking $175, right? Those things are extremely dangerous. And in the right market, there's nothing wrong with those. In the right market, they wouldn't be so extremely dangerous. But right now, in this level of volatility, no way in heck would I look to put on those kind of trades, right? We need to risk one to make one, and then in reality, we need to dial that back, and we need to keep track of that win rate. Because even if we are risking 2 to make 1, as long as we're doing it with a 75% win rate or better, we're good to go. I don't like it, but it's good to go. Okay? So we're talking about trades where we might make $12.50. And there's no rounding up from that, guys. That's the actual real value. We're talking about closing down trades. If it's 50 cents, right? If it's a $1 wide spread and we're risking 50 cents to make 50 cents, but then we're going to close it early, we're literally, honestly, truly looking to close these trade down at $12.50. And so if you're at a broker that's charging you $1 per option leg, and this has 2 legs, now you're looking at $10.50. I get it, right? Doesn't sound very enticing. But a credit spread is only one of the strategies that we can do here. It's only one of, and we don't have to do $1 wides. Depending on your account size, you can do $2 or $3 or $5. I really recommend that you don't get above $5. I mean, come on, guys. You're better off taking more than one, right? So instead of taking one $1 wide spread, you could take 5 $1 wide spreads. And that way, say you close one out at 10% profit, and then you close 2 out at 25% profit. You close the next one out at 40, and you let that last one run into 50% profit. Now you've locked in profit all along the way, making sure that if things go wrong and start to turn against you, you've already locked in wins, and you could still get that 50% on that last one, right? So there are many ways to do this. And scale is one of those. You will not ever become an effective options trader if you do not ever learn to scale. It is so critically important. All right. Trade small, trade often, but that means you got to have a high frequency. You can't be taking one trade a week. You need to be looking at taking one trade a day. And I know PDT does count, right? But you can open it on Friday, close it on Monday, open on Monday, close it on Tuesday. You get where I'm going with that, okay? And when the times do get rough and you do have to shut one down and break a day trade, you've still got 2 day trades left. Save them and don't use them, right? Don't use them until you need them. Of course, if you hit your target on the same day that you open it, save it. Don't close it at that target. Let it go through the night. Instead of closing it for 12.50, close it for 15 the next day, right? So you can save your PDT. Now we are going to get into more strategies afterwards, but in this video, I just wanted to talk about why. Why would we actually want to trade a weekly? You know, from week to week, Friday to Friday, why would we want to do that? Now you know, we got that covered. You go back and watch this again. There's a lot of reasons. The main reasons being, if you're going to trade small and you're going to trade often and you have a small account, you need to rotate that capital. You got to keep it going. All right, guys. I'll see you at the next video.